Let's bring in our Fed Day Power Team, former Wells Fargo chief economist John Silvia and Steve Auth, CIO of Global Equities for Federated Hermes with $634 billion in assets under management. John, I'll give it to you first. Powell hit the market's sweet spot. Look at the Dow up 339 points. Low of the session, the Dow had been down 154. What's the most important thing you believe came out of this meeting?
I think the fact that the inflation numbers continue to be stronger than what the Fed had expected. They're going to be raising interest rates. Clearly, from my side of the fence, and I'll leave the equities to Auth, I think the challenge is that bond prices are too high. Interest rates are way too low. You got a misallocation of capital, both in the government sovereign sector and the corporate bond sector. And to me, those interest rates have to rise going forward to compensate for inflation. And one other thing, there's a lot of commentary about the speed and the level of adjustment. I think in terms of inflation, we're going to have a long adjustment period to inflation, and our inflation numbers are higher than what the Fed has projected for 2022 and 2023.
Well, they're continuing to push investors into riskier stocks. I don't know if we can pull up the 30-year yield, but he specifically said, John, I don't know if you heard that. He said, I know the 30-year yield is low. Right now, I'm looking at the 30-year, hold on, 1.8. That's the 20-year, 1.85% for the 30-year. He seemed kind of relaxed and copacetic about that. Are you?
No, not at all. I mean, when you look at an investor who's looking at cash or government debt, you're looking at interest rates that are less than the rate of inflation. And that's even before taxes. So basically, people are looking at capital losses in the portion of their portfolio that is supposed to be incredibly safe. It certainly is not safe with respect to inflation risk.
Steve Auth, let me bring you into the conversation, and the timing is perfect. We are now hitting session highs. Dow Jones Industrials up 362 points. You got to tell me, as we see equities just take off running, where were you positioning before this meeting, and where are you looking now?
We were overweight equities, Liz. As you know, we've got a 4,800 target on the S&P for the end of this year. It's been out there a long time. We think we're going to get there. We're 5,300 next year. And we think this is bullish. Long-term investors, our biggest worry has been the Fed is so behind the curve and so oblivious that they're eventually going to wake up and really have to grind the economy into a recession. And that would be an early end of the cycle. So this raises the odds that the cycle is going to be extended. We want to be in the cyclicals. We want to be in the stocks that are in the crosshairs of rising rates. I agree with John. The bond market seems to be taking it kind of smoothly here for the moment, thinking, oh, well, we trust the Fed. But I mean, trust the Fed so far hasn't really been a good course of action. They've been way behind the curve here. And I would guess with him that we're heading for higher rates. It's going to affect, the growth stocks a little bit because their valuations are going to compress. We like right now stocks versus bonds for sure. And within stocks, we're tilting towards the financials, the energy stocks, consumer discretionary names that we think are really cheap. A lot of these stocks are down 10, 20% in the last 3 months. And they're looking at some pretty good nominal numbers, we think, in the next 12 to 24 months. So,
I think Steve's point's well taken.
Go ahead.
I think Steve's point's well taken. Yes, the Fed's a little bit late. They should have been doing something before. But this is a stitch in time. They're doing something. It will prolong the cycle. It is better for the economy longer term, the Fed to take a little bit of steam out of the interest rates and the bonds and provide some returns. But I think Steve's got it right. It prolongs the economic cycle. It's good for equity investors.
Can I just let people know that there is some breaking news on Apple at the moment. Apple is closing 3 stores, and they are basically saying, let me just check this, and I don't know if we can pull up an Apple chart. We're working on it. But the news is such that Apple says that it's closing 3 stores. The stock is up about 2.5% regardless here.
All
they're confirming the closure here. I don't see exactly the reason. But
Probably
yeah, it's probably
related,
Omicron.
Liz.
But Apple says
Right.
all employees will be tested prior to reopening. We do see the stock moving higher on this news. And, you know, Jay Powell did reference Omicron, and I want people to hear what he specifically said about it. This, as folks, everybody knows, we just passed 800,000 deaths here in the United States when it comes to COVID overall. Let's listen to what he said, and John, you can then comment.
Depend, on how much it suppresses demand as opposed to suppressing supply. It is not clear how big the effects would be on either inflation or growth or hiring, on top of what's already going on, which is quite a strong, wave of Delta that's hitting large parts of the country.
You know, you add this Apple news into it, you're telling me there's not going to be some sort of renewed impact, John, from the Omicron virus. What are you foreseeing as an economist?
No, I would say that the Omicron virus does have an impact, certainly not as much as Delta. I think we certainly have a lot more people who are fully vaccinated. A lot more people are cautious now with respect to their personal activities. So it will be a slight negative impact, but nothing like the Delta impact. I think when I looked at some of my recent presentations to economic groups in Philadelphia and Las Vegas, my emphasis was you still have sustained economic growth. I think the Fed's okay on its economic forecast. I still think they're a little bit too low on their inflation forecast.
Okay. Gentlemen, great to have you, Steve and John. And I would just say here that Apple shares are up 2.5%, but it is due to Omicron. We have not heard exactly the locations of the 3 stores that will be closing at the moment, but we're keeping you posted. Apple, of course, is a Dow component, not hurting the Dow right now. Folks, we are up nearly 400 points